Right, we are going to be getting more earnings results this week from the Canadian banks. Scotia, for example, reports tomorrow, and then we hear from BMO and National on Wednesday, and RBC and CIBC on Thursday. Our guest says he has exposure to two Canadian banks, Royal and BMO. We're joined by Amit Joshi, Portfolio Manager at Barometer Capital Management. Thanks very much indeed for joining us.
Hi, Andrew. Thanks for having me.
Broadly speaking, what are you looking out for from the banks this week?
Yeah, look, for the banks, we've come into Canadian bank earnings underweight the sector. Our only exposure right now, like you mentioned, is Royal Bank and Bank of Montreal. And just given the heightened volatility we've been seeing coming into this year with the tariffs and the potential of a global trade war here, we felt credit and the consumer could be under pressure. So lined up on our bank exposure itself. The results from TD last week were encouraging, especially on the credit side of things. Credit came in a lot better than expected. So that is encouraging for the rest of the group, but that is something that we will really want to key in on as the rest of the group reports over the course of this week. And the other side that we'll really be touching on and paying close attention to will be Canadian banking. TD's results did show a bit of a slowdown there, which isn't surprising, kind of given the impacts of tariffs in our local economy here. So we'll continue to watch for that.
What attracts you to BMO stock right now? I mean, they have a big presence south of the border.
Yeah, really good question. For us, it felt like for Bank of Montreal, their prior credit issues were kind of in the rearview mirror here, and we had an opportunity to add the stock at a valuation that's lower than where it's historically traded, with a great franchise in Canada and the optionality in the U.S. itself, particularly when TD has been having some of their issues in the U.S. with some of the AML issues that they had earlier in the year itself. So for that, we've liked BMO. We are going to be paying close attention to the commercial loan growth for that U.S. business. That's something that could be under pressure. So we'll be definitely watching for the results of that particular group and paying keen attention to that.
You have some other stock ideas for us. Fairfax Financial, FFH. That stock has been doing well lately, trading near record highs. What attracts you there?
Yeah, for us, Andrew, the two sectors that have stood out the most for us are financials and industrials. And when we narrow in on financials, particularly the insurance subsector has been one of the strongest year to date. And Fairfax has been a leader in that group. Recently they put up their Q1 earnings results, and they were very, very strong on the back of underwriting income and investment gains. And the annual CEO letter that we get from Prem Watsa struck a really confident tone. We were encouraged to see that, and we were encouraged with the increase in guidance for interest and dividend income going up to $2.5 billion annually from $2 billion. So that's something that we've really liked. It's consistently driving that dividend interest income higher. So that provides a lot of smoothness to the earnings itself. And the investment gains have been performing very well for the business.
Yeah, the stock at a record high today, according to my screen. You have a couple of engineering companies for us, WSP Global and Stantec. Maybe start off with WSP. What attracts you there?
Sure. Yeah, the thesis for both companies is very similar, Andrew. Mm-hmm. As I said, industrial is another area of the market where we've been seeing a lot of strength, particularly coming out of the downtick that we saw in the market itself. And particularly here in Canada, the engineering and consulting companies have been leaders in the industrial group. Both of them have good exposure to the U.S. And as was evident in their quarterly reports, organic growth has been really strong. And both companies have been very acquisitive in M&A, buying other local mom and pop engineering and consulting companies and adding to their platforms. And both companies have a very strong pedigree of being very good integrators of the acquisitions that they make. So that's one of the reasons we like both the companies. Backlogs for both Stantec and WSP are sitting at historical highs. A lot of tailwinds for these businesses in terms of reshoring, infrastructure spending, things that haven't been negatively impacted by tariffs or the global trade war for the time being. And E&C companies, the consulting companies themselves, are a little less volatile than construction companies as they're not taking on any project risk or any risk of cost overruns.
We'd better jump. Amit, thank you very much indeed for joining us.
Thank you, Andrew.
Amit Joshi, Portfolio Manager at Barometer Capital Management. Coming up.